How to build an alternative corporate TFSA through life insurance. Now, most people think of life insurance as just a safety net for their family, but what if it could be so much more? So in today's videos, we're going to explore how life insurance can be a smart way to build wealth and secure your financial future. Hi, my name is Laurent Munier, and I'm a partner and advisor here at Safe Pacific Financial. And today we're going to talk about our bread and butter, whole life insurance. So we've been designing high cash value whole life insurance policies to help our clients build their wealth and secure their legacy for almost 15 years now. Whole life insurance can be a powerful tool for building and protecting wealth over the long term. So when used strategically, it offers benefits that go far beyond just a death benefit, like tax-free growth, guaranteed cash values, and a reliable way to pass on wealth to future generations. So for those that want to create a lasting financial security, whole life insurance is definitely worth looking at. In today's video, we're going to explore why whole life insurance is a powerful tool for those who want to build significant wealth, how we use it for our clients to manage taxes today and build multi-generational wealth tomorrow, and when term insurance makes more sense and when it doesn't. Let's dive in. So what are we talking about here when we say what is an alternative corporate TFSA and why you should care about it? Right off the top, I need to say this for compliance because I know a lot of people watch our videos. Whole life insurance is not a TFSA. A TFSA is a specific kind of investment account that has certain tax benefits. TFSAs are great and we recommend them for a lot of people. Personally, my TFSA is maxed out and I love it. In this video, we're making an analogy. So the right kind of whole life policy that's designed to build high cash values can act similar to a TFSA because the cash value growth inside the policy is tax-free until you take the money out. Now that we've got that out of the way, here's the rest of the video. Most business owners want a way to grow their corporate cash tax efficiently. The problem, there aren't TFSAs and RRSPs for your corporation. So when you invest your retained earnings or your saved up profits inside the corporation, it's a non-registered account that's fully taxable at the highest marginal tax rate. Investing corporate dollars in traditional taxable accounts triggers annual taxes on interest or dividends or capital gains or whatever you're invested in, and this can significantly erode your returns over time. A corporate TFSA is not an official account type. It's a strategy that uses a corporate-owned whole life insurance policy to shelter your corporate assets from tax. Think of it as a super tax-free savings account on steroids for your corporation. Now, here's how it works. You get the tax-free growth. So the cash value in the whole life policy grows tax-free as long as it's inside the policy. You get tax-free access to the money. And you can access the cash value tax-free through various types of loans like policy loans or collateral loans, which allows you to keep your cash money compounding inside the policy indefinitely. And there's a tax-free death benefit. Life insurance in Canada pays out tax-free, maximizing the legacy that you leave behind. This strategy allows your corporate dollars to grow uninterrupted by taxes, making it a powerful way to build wealth for the long term. And who really needs whole life insurance? Whole life insurance is not for everyone. It's designed for those who are looking to build, protect, and pass on significant wealth. Who should consider it? Number one, business owners. So if you have cash saved inside your corporation or ideally inside a holding company, you're probably tired of watching your cash get taxed year after year. A corporate-owned whole life insurance policy is a great place to put that money, allowing that cash to grow tax-free. Plus, the tax-free death benefit can be distributed to the shareholders of the company through your Capital Dividend Account. Higher net worth families. We work with a lot of families who've built up significant, say, real estate portfolios or sold a business. The real estate could include commercial properties, rental properties, vacation home, other assets that are going to have a significant capital gain over time. And that tax bill on death can be really big. The right whole life insurance policy can provide a tax-free lump sum when you pass so that your family or estate can pay the capital gains bill and then the family keeps the real estate assets in the family. People who want to build a legacy. So if you want to pass on multi-generational wealth without giving half your money to the CRA, whole life insurance offers tax-free growth, tax-free access to the money, and a tax-free death benefit at the end. All very powerful tools for preserving your wealth. Now, I promise I talk about term insurance. So when does it make sense and when does it not make sense? So at Safe Pacific, we often, very often recommend term life insurance for young families, and this is for good reason. Term insurance is straightforward, it's affordable, and it provides essential financial protection during peak earning years. So you're probably juggling a mortgage and raising kids or managing other financial responsibilities. And for many Canadians, term insurance is the best way to ensure that their loved ones are protected in the short and medium term. But term life insurance is designed to be temporary. It's like renting coverage for a set period of time, usually 10 years or 20 years or 30 years, after which the policy either expires or it renews, usually at a significantly higher price. And the thinking here is that by the time the term expires, your mortgage is mostly paid off, your kids are probably financially independent, and you've built up enough other assets that you don't necessarily need the insurance anymore. However, this is also a stage when new challenges arise. So managing estate taxes, preserving family wealth, ensuring a smooth transfer of assets to your beneficiaries. And this is where the whole life comes into play. Unlike term insurance, whole life insurance lasts for your entire life, regardless if you are 80 or 90 or 100 years old. Whole life also comes with benefits that go far beyond a simple death benefit, including tax-free growth, the guaranteed cash values, and tax-free death benefit. And the key differences, let's quickly recap here. So term life insurance, ideal for temporary needs when your financial obligations are high and your wealth is still growing. It provides affordable coverage to protect your family during the critical years, but it expires when you might need coverage for estate planning or wealth transfer reasons. Whole life insurance, on the other side, is best suited for those who want permanent coverage with the additional benefits like the tax-free growth, tax-efficient wealth transfer, and those guaranteed death benefits. It's a powerful tool for business owners or higher net worth individuals or families, and those who want to preserve and pass on wealth efficiently. So bottom line, term insurance for temporary protection during your peak earning years, and then consider transitioning to whole life insurance as you move at your wealth preservation years. The right combination of term and whole life can provide a comprehensive strategy that evolves with your financial needs. And a little hack here, you want to get your term insurance with a company that also offers whole life insurance. That way, when the term expires or even before, you have the option to do what's called convert. So you can convert it to a whole life policy without going through underwriting again or having to show proof of insurability. Your health today locks in the insurance in case anything happens to you in that next 10 or 20 years of the term, and then maybe you can't qualify for a new whole life policy at the end of the term. Now, how do you use the whole life insurance? So we use whole life insurance strategically to help our clients to build tax-free wealth, cover future tax liabilities, and to pass on those assets quickly and privately to the next generation. And so here's some of the ways that we do it. So you can leverage corporate cash and you can maximize that tax-free growth if you're a business owner. So for business owners, that excess corporate cash sitting in your corporation can quickly get eaten up by either tax if it's left in a traditional taxable account, or it gets eaten up by inflation if you're just leaving it in cash. Now, at Safe Pacific, we use whole life insurance strategically to convert that excess cash into a tax-free growth engine. By overfunding the corporate-owned whole life policy, it allows your corporate dollars to grow inside the policy completely tax-free. And then this approach not only maximizes the tax-free compounding, but it also protects it from annual taxes on, interests or dividends or capital gains, whatever else you would invest in. As the cash value grows, you gain access to a reliable, tax-efficient source of funds that can be used for business opportunities or emergencies or even retirement planning without having to trigger those annual tax liabilities. To max out that deposit option, you kind of transform the whole life insurance into this thing that we call the alternative corporate TFSA. One of the most powerful features of the whole life insurance is the deposit option. So this allows you to overfund the policy, which means that you can add more cash into it, more than just the base premium. And by overfunding the policy, you can accelerate the growth of the cash value, which continues to compound tax-free year after year. Unlike a traditional TFSA, which has really low contribution limits, this year it's $7,000, a corporate-owned whole life policy allows for significantly higher contributions. So we have clients putting in hundreds of thousands and millions of dollars per year into these types of policies. And this strategy ensures that your corporate dollars grow faster. It provides a substantial tax-free asset that can be accessed during your lifetime and then passed on to your beneficiaries at the end. So we'll talk about policy loans and using your policy as collateral for other loans. Whole life insurance offers a unique advantage that few other financial products can match. It's the ability to borrow against the policy cash value for a really high loan to value. So usually 80, 90, or 100% loan to value. And we leverage this feature to help our clients access liquidity efficiently and tax-free for whatever they want. And generally, we're recommending for investment or for business growth. Policy loans allow you to borrow against the accumulated cash value of the policy at pretty competitive interest rates, and it provides a flexible source of funds for the business expansion or real estate investments or personal financial needs. Here in Canada, policy loans become taxable once the loan value is higher than your ACB, which is your adjusted cost base. So this is something that you have to look out for. And it's very different than in the US. In the US, policy loans are tax-free all the time. And the majority of videos about this on YouTube are American videos. So they always talk about tax-free policy loans, and it does not work like that in Canada. In Canada, policy loans are tax-free up to a certain point, and then after you get higher than your ACB, they can become taxable. Since you're borrowing against your own cash value and you're borrowing from that insurance company, the repayment terms can be really flexible compared to traditional loans. You can also do what's called a third-party loan, like a collateral loan from a third-party financial institution like a bank. They will accept the cash value of a whole life insurance policy as collateral for larger loans. So this means that you can secure significant financing for your business growth or property acquisition or other investments without having to liquidate assets or trigger capital gains tax. And then meanwhile, the cash value in the policy continues to grow tax-free. So you get that dual benefit of the liquidity of using the money, but you also get that long-term wealth growth and that uninterrupted compounding. Essentially, your $1 is growing in two places, right? Once inside the policy, and then hopefully in whatever investment you make with the borrowed funds. Hopefully you're investing well and that's also growing. There is a tax-free death benefit. So that efficient wealth transfer, either if it's personally, it gets paid straight to your beneficiaries, or if it's corporate, it gets paid to the corporation and then it can flow through a Capital Dividend Account or a CDA. One of the most powerful benefits of the corporate-owned whole life insurance policy is that tax-free death benefit, which allows for an efficient and tax-free transfer of wealth to your heirs. And we structure these policies to maximize that tax-free death benefit through your Capital Dividend Account. The CDA is a special account, and it allows private corporations to distribute life insurance proceeds tax-free to Canadian resident shareholders. Talk to your accountant about the Capital Dividend Account or your CDA and what it can do for you. When the death benefit is paid out, anything above the policy's adjusted cost base or your ACB gets credited to the CDA. So with a life insurance policy, your ACB will grind down to almost zero over time. So if you have the policy for a long time, almost all of the death benefit will credit the CDA and can flow to the company shareholders in a tax-free way. It can be distributed tax-free to shareholders, and this saves them a huge amount in taxes. This strategy ensures that your beneficiaries receive the full value of the death benefit without erosion from taxes, which makes it an ideal tool for business owners and for high net worth individuals who are focused on preserving the legacy. Eliminating dividend taxes or capital gain taxes on that death benefit, the CDA allows for a seamless and a tax-efficient transfer of wealth to your heirs, ensuring that more of your hard-earned money stays in your family or in your business. Now I'm going to give you a real life example that happens to a lot of Canadians. And we'll talk about how this corporate-owned whole life insurance policy can save your Whistler cottage from a massive tax bill. So imagine that you bought the family ski cottage in Whistler a long time ago for $200,000. And we all know that Whistler real estate has gone crazy, and now that property is worth $2 million. And this is not an outlandish scenario in BC. This is going to cause a huge capital gain on that property when you die, if you want to leave that property to your kids and you want to make sure they keep it in the family. At the 50% inclusion rate, they're going to have to pay tax on $900,000. So will your kids have that cash on hand to pay the CRA? Or do they have to sell the Whistler property where you taught them to ski and where you spent every Christmas as a family and you want to keep it in the family? For quick ballpark numbers, do your kids have an extra $450,000 kicking around to pay the taxes so they can keep the Whistler cottage when you die? Right. How does the whole life policy save the day? Well, this is where that permanent whole life insurance policy comes in as a powerful tax planning tool. So by buying the whole life insurance policy today with a death benefit to cover those estimated capital gains in the future, you can make sure that your kids don't have to sell the property to pay the CRA. And then this is how it works, right? The tax-free death benefit from the life insurance policy pays out tax-free to either your corporation and then through the CDA to the beneficiaries, or if you're holding it personally, pays out straight to your beneficiaries. Then they take that insurance money to pay the CRA and they get to keep the Whistler cottage. And there's some benefits, right? Number one, it preserves family assets. It ensures that your Whistler cottage stays in the family without triggering a forced sale because they can't afford the taxes. Number two, it's an efficient wealth transfer. It leverages the tax-free nature of the death benefit and it passes on this wealth efficiently. And three, it's tax-free growth, right? The cash value of the policy is growing tax-free while you're alive, and it can provide additional liquidity while you're alive if you need. A real-world solution to real-world problems, right? Many Canadian families face this exact situation with your cottage or vacation home or even rental properties or commercial buildings if you want to keep the stuff in the family. Without proper planning, the tax bill on these assets can force your kids to sell those properties that have been in the family. Maybe you're the one who started it, or maybe it's been in the family for generations. And by integrating a corporate-owned whole life insurance policy into your financial plan, you can avoid this outcome and ensure that the assets pass on smoothly and tax efficiently, right? That your kids or whoever your beneficiary is has the money to pay the taxes so that they can keep the real estate or the portfolio or whatever assets, the business. And how do you build the corporate TFSA with whole life insurance? So if you have a corporation and it has built up retained earnings, you're probably looking for a tax efficient way to invest these funds. So the corporate whole life insurance policy offers the tax-free alternative to traditional investment accounts that are subject to high annual tax. And just a quick recap here. So you've got that tax-free growth. So your cash value can grow inside the policy without being eroded by taxes every year. You can access the money through policy loans or collateral loans. So this gives you liquidity in a tax-free way, and it lets your investment inside the policy continue to compound and grow over time. And then we have the Capital Dividend Account, right? The CDA. The insurance pays to the corporation tax-free, creates the CDA, which can now pass on to your shareholders, all or mostly tax-free. So is this strategy right for you? Whole life insurance is not a one-size-fits-all solution, but for business owners or higher net worth individuals, or for people who want to pass on multi-generational wealth, it's a game changer. If you're looking to minimize your taxes and to grow and preserve your wealth and to ensure a smooth transfer of assets to the next generation, whole life insurance could be a cornerstone of your financial strategy. Is it right for you? I don't know. Let's find out. The best way to do this is get in touch through our website at safepacific.com. There, fill out the form and it'll come to me. Someone on our team will get back to you within 24 hours on business days, and we'll set up a time to meet and get a better understanding of your current situation and your goals and concerns moving forward. We work with successful Canadian business owners and high net worth families all day, all across the country. So if that's you, let's connect. Now that's it for me today, but Before you go, can I ask a favor? If you got value from today's video, can you please click the like button or click the subscribe button? This helps the algorithm share the video to more people like you. Thanks for watching. I'll see you next time.